If you're just joining us, it was a record day on Wall Street. The Nasdaq hitting, yeah, you guessed it, another all-time high. And this time, it happened to bring along its bigger cousin, the S&P 500. That index closing at its highest level ever. But your next guest says the record rally may be starting to run on empty. Morgan Stanley's Mike Wilson joining us now on the CNBC Newsline. Mike, thank you very much for joining us. Why do you think that? Does it have to do with the move in bonds, which, as you yourself noted, the move we saw in 10-year yields was the third fastest in 5 days ever in modern history?
Yeah, I mean, that's part of it, Brian. I mean, good to be with you tonight. I mean, I think we're at an interesting, point here. I mean, markets technically have had, this powerful move. We're right into resistance on the S&P 500. Nasdaq is well through resistance. I mean, as you mentioned, has just been powering higher for the last several months. But markets tend to react to these levels. And I'm in the camp that we're in a bull market. It's a new economic cycle, so we're constructive. But, bull markets have corrections. And if there is a time this year since March, I think this is probably a good time, both seasonally, right, August, September. We have this fiscal cliff negotiation, which is, coming down to the 11th hour, is going to be an overhang. You talked about Walmart and Home Depot earlier. Part of the reason why they probably gave back a little bit today, which, by the way, is noise, I agree some of the earlier comments, is that, I mean, look, these things have been big beneficiaries of this fiscal stimulus, and if that's going to be delayed or maybe not come through, I mean, they're going to be victims of that. So I think the market is starting to think about these ideas that, hey, we've come a long way, let's digest this, and this is a seasonal time of the year, and yeah, this is probably a time where we have a little bit of a pullback.
So the idea basically for clients of Morgan Stanley is, wait, you got a lot of cash. Kate Rooney just talked about how much cash is out there on the sidelines, so to speak. Wait, you expect to pull back. There'll be a better buying opportunity soon.
Yeah, for folks who haven't been playing along, I mean, I think if you're just now deciding that this is something you just can't take anymore, you have to jump in as you're making a new all-time high, probably not a great decision. If you're somebody who's been dollar cost averaging the whole time, stay with your program. I mean, it's a bull market, so let's not kid ourselves about that. Some of the things you're talking about earlier on the program, I completely agree with. I mean, if you believe it's a bull market, it should now start to broaden out a little bit more. And some of that's around the recovery stocks, if you want to call them that. But really, it's a broadening out of stocks that actually have been underperforming for 2 years. And whether that's in the financials area, some of the industrial space, consumer cyclicals that will be beneficiaries of the reopening. I mean, those are the areas where we think the operating leverage story is going to be much more interesting over the course of the next year. And that's probably not appreciated. So that's the other part of the advice that we're giving folks is if you are going to put money back into the market now, look for some of the areas that have been laggards, not the ones that have been making new highs every other day.
Hey, Mike, obviously, thanks for being here. So at what point is the market going to want the denominator portion of this equation to start to move? That would be GDP. I mean, obviously the numerator in terms of market cap just goes up every day given the market move. But GDP does not move. As a matter of fact, it's probably going the wrong way. At what point does GDP start to have to play catch up? Because in terms of that ratio, we're at ridiculous levels.
Yeah, Guy, I mean, you've been doing this a long time like me. You understand. I mean, when you go into recession, you come out of that, you always get the revaluation first, right? And that's, rates have been falling precipitously, particularly on a real basis, since, basically the first part of this year. And, of course, when we went into recession, they collapsed. Then we got the revaluation on the back of those lower rates and the idea that, things are troughing and the market's looking forward. Well, now it's show me time. So I think that period begins now, meaning in the third quarter and the fourth quarter, the things that are going to start to outperform now are the stocks that have the biggest upside surprises to expectations, okay? Some of that could be still some of these leadership names in the tech space. They're going to continue to do really, really well. But it's also going to be in areas where, the expectations have been hammered and where people don't think anything good is going on, right? So, but it is show me time now, Guy. You're exactly right. We had the revaluation, and the upside from here over the course of the next year is going to come through upside in earnings.